There we go. Okay, recording has started, and this is the Market Structure Edge demo for August 24. And if you're, if you're new and I just shocked you, don't worry. We'll be just fine. And I will give you some basics. I want to hit at least one core basic item if you've come here to this demo to learn how to use the platform. And then I want to go through some things that demonstrate the effectiveness of the data in different ways. It can be used for short-term trading. It can be used for longer-term portfolios. I use it for short-term trading generally, but I will also modulate my exposure to the market based on the longer range data, John Cook, kind of like you do. So let me do that. I'm going to share my screen here. And we will, we'll be punctual. The only rules, if you haven't done this before, there are only two. One, mute yourself while we're doing this, but number two, ask questions. Don't be shy. There isn't anything you can't ask, and don't feel like, well, I don't know what I'm doing. I don't want to say anything. Jump in. No one will think less of you. So please do that. Let's see here. Yeah, Pam, thank you. Yeah, I mean, you should see her helmet. It didn't break and it didn't come off, but the best way to picture this is imagine entering a room at 20 miles an hour and slamming into the floor. That's basically what happened. But her helmet, she'd be dead without that helmet. The side of it looks like she took shrapnel into it. But her profanity's back. She's, she did these cognitive tests and she outperformed 99% of members of government statistically on that test. So we feel good about it. She's kind of tired today, but she's good. Thank you very much, you guys. Appreciate your concern. Okay, let me share my screen. Okay. There we did not work with my finger. Okay. And I apologize for the setup. I don't even have my laptop. I mean, I grabbed some stuff and the dog and went down the hill, and I've been wearing the same clothes, so good thing you're not in the room with me, but I'm stuck with my Surface, my Microsoft Surface as a result. Okay. So what I want to share with you first, if you say, I want to know how to use Edge, I'm going to give you one basic principle which underpins it all. I mean, everybody wants to have some reason to buy and sell things, and you could use technical signals, you could use fundamental signals. What is something trading at 13 or 20 times earnings? Those are reasons. They don't reflect what all the money's doing. Technical signals are generally used for risk management. Fundamentals underpin stock picking for portfolios and quality characteristics, but those are a small part of the market anymore. 70% of assets in the market, if you look at the largest asset managers, are following models that allocate money to equities as an asset class, and they're not looking at that stuff. They're looking at value, growth, market cap, volatility more than anything else. So what Edge does is to say, well, if we looked at all of those things as having an impact on supply and demand, that is a more reliable way to think about when to buy and sell things. And it's the underpinning principle of everything on Market Structure Edge. This is demand. I'm going to zoom this in, and here's the reason I have this large cap portfolio up here is because it is the great bulk of market cap. 95% of market cap is in the Russell 1000, the 1,000 largest stocks. Well, here's a 10% sample, basically, of that group. And what is demand doing? Well, demand has fallen below 5. So if you need at least 5 to have balanced buying and selling, let's say, we know we're not quite there yet. So even after, NVIDIA has outstanding results, and the market before it opened, the futures way up. Why are they down? Because overall, the supply demand equation isn't great. And to me, that's much more reliable. If our aim is to not lose money, than whether something is trading at 13 or 20 times earnings. Look, I wish it worked that way, because then the market would be a better reflection of the underlying performance of business, but it's not. The supply side, short volume. This is the data set associated with what's called the modified uptick rule. In 2010, after a lot of complaints from the market after the uptick rule was done away with in 2007, implemented these girders that govern when stocks can be shorted. And there's a data set that FINRA articulates, requires from broker dealers, that says, are the shares involved in this trade owned by you or your customer, or have they been borrowed? And if you're engaged in what's called bona fide market making, you can create stock without having to locate shares to short. Well, that's all measurable because that data is distributed and we consume it. We have from day one when it was first launched in 2010. So we have 13 years of experience looking at that data and understanding how to look at it. And so, the supply side's fine. It's trending up a little bit, but it's around, if you look at the large caps, around 45.6%, which is better than the market, but half the volume is borrowed. And on the demand side, if it's at, this is actually 4.1, it's a little better than the overall S&P 500, which isn't, it has some mid caps in it. But that's what we're looking at. Everything we will look at through that lens. You could look at NVIDIA that way. Before results, you could say, well, what is the money doing in NVIDIA? And this will reflect everything that everybody knows. And you can see what was happening. So demand bottomed right into options expirations, August monthly options expirations, and demand began to rise ahead of results. And so demand rose, supply rose, or price rose. Supply, it's right at 50%, a little bit less than that. I mean, would I buy that? Yeah. I mean, it's not bad. It's not my first choice, but rising demand and falling supply will generally lift price. It's not an optimal condition, believe it or not. But that principle underpins everything. This is the green part of the graph, and if you, and there are some of you who said, well, I can't distinguish between the green and the gray. The best way to know which one is which is this green part of the graph, if you can see that, it always will comport to this 10-point scale. The gray part that dips and moves all over the place will correspond to the other side, so that you can see, well, the gray part of the graph it was at $471.16 yesterday. That's where it closed. And then down here, that's 49% short. That's how to look at it. Supply and demand. When there's excess demand and insufficient supply, prices rise. When demand falls and supply rises, prices tend to decline. Great illustration would be a stock that I traded a couple weeks back. I routinely will do this with this stock, but here's what's happening. If demand deteriorates and supply bottoms and begins to rise, price will fall. We just won't perform as well. I mean, this is much better back here. If supply falls and demand is very steady, there's an opportunity to make returns in there. And I'm only after, 1% in a stock like that. But it's a very reliable, not perfect, but very reliable principle to follow. And you can use that over and over. You could use it to create portfolios. This is another thing that I thought I would show you. So say you have a longer range objective and you want to create a portfolio and maybe use part of it for a longer term investment. Here's a way that you could do this. You could say, well, we want to find stocks that spend a lot of time at 10, excess demand. NVIDIA spends a lot of time at 10, has. When it was performing great, boy, it was at 10 a lot. When that deteriorates, it's a good reason to leave. So you could say, well, let's find stocks that are at 10, at least in the trailing 30 trading days. That's what this will default to, at least 15 days in there. That's what that means. If over the last 30 days, something spent 15 of those days at 10, we want to find that. And let's add a couple of other things in here. We want let's say a standard deviation between supply and demand. There are multiple ways to arrive at this. This is just another way to do it. So let's say we want to make it greater or equal to, 2. So we have two standard deviations in here. Let's say we want liquid stock. So I like to do that this way. You could do it with volume, you could do it with market cap. I like to say, well, it trades more than $3,000 every time it trades. For perspective, what that means. NVIDIA trades, I don't have it right, the latest right in front of me, but let's say over 500,000 times a day. Tesla trades 1.5 million times a day, not shares. That's the number of transactions. Well, what is the dollar value of each of those transactions? Well, it's, Tesla's like $25,000 a trade. So we want to find stocks that are at least $3,000 a trade, because that will be machines like that stuff. It's easier to get into and out of. Again, these are just examples. And so let's just take these, and then we can narrow. So if we filter for those stocks, we're probably not going to find very many that have those conditions right now. Yeah, there are only 7 of them. And so it's very interesting to see where the concentration is. What has been the best performing sector over the trailing month? Energy. There you go. And like 6 of 7 of these are energies. Now, a number of them have very high short volume. We could take those out. But it's a principle that you could use. You could say, and here's what it looks like. Why would Apache have done well? Well, when demand rose over 5 and it stayed there this whole time, this is price. Price has just gone up and up and up. And when would you leave? As soon as it deteriorates. As soon as demand deteriorates, you could swap out Apache for somebody else. And you can just do that over and over and have a longer range portfolio, not short-term trading, different principles there, where you want very short gaps and you want to capture part of volatility. But it's a way. I heard, I was coming over from the hospital back to the hotel room here, and I heard Dan Niles on CNBC. He runs a hedge fund now, but I met him probably 20 years ago or more when he was a sell side analyst, and he says, well, one of the things we do is we look at good fundamentals in stocks, and we buy things that are trading at 13 times earnings that we think have faster growth rates than that. And if they rise to 20 times earnings, then we get rid of them. It's a way. That is a way to approach it. The trouble with that is only 1 out of $10 in the market is motivated by that. Well, is that then more reliable than this? No, it's not. And I'll show you just illustrative what I mean. We're building a little utility that will become the new version of the back testing engine. And right now it's in very rudimentary form, but I hope you can see this. I'm just going to show you some data to just demonstrate how this works. So I set the area. I want to run data from July 5th through yesterday. And I'm going to set up a minimum. The initial value is $10,000, and I want to have 10 stocks in this portfolio, and I want to have at least 5 in it at any given time, and I'll replace no more than 5 at a time. That's what that's saying. And so I want to look for stuff that is at least is greater than 9.0 demand, and that the dollars per day. It's another way to do it. It's 100 million. I want $100 million of dollars per day. That's another feature that you can look for. And I want the short volume trend on a 5-day basis to be down. That's what this is. Less than 0 means the trend is down. And I want to find stocks that have less than 50% short volume and that the price close is at least $20. I want a $20 stock. And then we exit if demand deteriorates. It goes from, if it goes from 10 to 9, we're leaving. And if short volume is up, basically, I just said, if it's up more than 10% from my maximum, we're leaving. So if it's over 55%, we're leaving. Then I can just run this utility to look for those criteria. And it's a way to test the legitimacy of the data. And it's really pretty interesting. So here's our initial portfolio. It went and looked, it takes the first 10 that meet those criteria, there they are. Doesn't really matter what they are. I'm illustrating that it doesn't matter. Doesn't matter what it doesn't matter what their fundamentals are. Doesn't matter if they're 13 times or 20 times earnings. That's not what money values. Money generally values size. So we found our initial set, and so we take the closing price from so we enter the portfolio really on July 7th because we found them with the closing price on the 6th. And so the first day we buy these things will be July 7th. So here it is, July 7th. Now we're up to 10,131. We've gained 1.3%. So we're just going to keep running this. 10th, we're up 2.5%. You see that? I'll skip ahead. We're not going to look at every day, but it works very effectively, right? If I step forward to July 13th, now we're up 5% on our portfolio. And we're just following those criteria. It's totally quantitative, totally mathematical. And there's a turning point. A turning point arrives. I'm going to go all the way up here at about, now we're up, let's see, where are we now? We're up 7%. I think we went up 8%. Total. July 21, 6%. July 24, see that, 6%. And I'm going somewhere with this. I want to illustrate a point that will lead us right to where we'll finish today, too. There we're up 7.7% as of July 25th. Then if you were to continue on, by the early August, we're starting to deteriorate. August 1, 6. By August 2, we're 5.7. By August 3, we're down to 4.8. We've lost almost 50%, call it 40% of the value of the portfolio, all of our gains anyway, okay? Now, there are two key points. Number one, the math work. They work. They will show you things with a higher probability of producing returns, and math works better than rational thought because that's what we have. We have a market that works on the basis of mathematics and machines and asset allocation and so on. But there will be a turning point. Now let's go back to the platform and you'll see why. This is the importance of broad market sentiment. Where did we rise above 6? Well, back here in early July. Where did it begin to tip down? Well, you could look here and say, well, right in this period of time, I'm going to zoom that in a little bit more. In here, you can look at the upper right and you'll see the number. See that broad sentiment 6.3, 6.2, and you say, well, maybe there we leave 6.1, then it's 6.2. Over here, we hit 6.7, 6.6, 6.5, 6.4. It's past options expirations in here, but it's beginning to deteriorate. Demand is deteriorating. Go down to supply. What is supply doing? Rising. If supply is rising and demand is falling, you should leave because the probability, or you go short because the probability, and I think Brian shorted the market, I shorted the market there. Because now the probability is that it's not going to be linear, but the probability is that your long returns will deteriorate and your short returns will increase. And it's not more complicated than that in some ways. Now, why does that work? Well, because the market is mathematical. Machines, algorithms set prices. They're very aware of how prices are changing and risks, and they don't take much risk. And big institutions commit money to stocks, and if there are changes to the conditions, they reduce exposure or they shift to low volatility, which we will see in the low volatility portfolio, but that's what happens. And if you look at where we are now, why did the market have a way up and it can't hold on to gains? And I don't know what it's going to do. I don't worry about it every day, but I can see that demand has deteriorated all the way to the green line. We're probably very close to a short-term bottom. Supply has come down some, but it remains pretty high at 49.3%. I know those aren't great conditions. I looked at a couple of things today. In fact, I'll show you one. But the lesson, there are times when you should have less exposure to the market, and no amount of great supply-demand divergences is going to change the fact that the risk increases. But if you're using that math when demand is rising, it works very well. And if you're not a short-term trader, you could do that. You could create a portfolio that spends a lot of time at 10. You could create one that's all at 5. If we had more time, I'd show you that. I'll save that for next time maybe, and show you how you could build a portfolio of things at 5 with declining supply, and it will very consistently outperform the broad market, and you could just reweight it. That's for those who don't want to sit and watch things. I looked at once the market pulled back today, I'm looking at the low volatility portfolio, and I'm looking at those things, and I see Microsoft is down basically all of its intraday volatility. I did not buy it. Now maybe it would be fine. I'll tell you why I didn't. Here's Microsoft. So this is, yeah, I mean, it's good. Microsoft spends a lot of time at 5. It's a very good value stock. It can be a growth stock. People will use it for both portfolios as an asset allocation choice. Here it is at 5. And here's the supply side, and it fell day over day. That's how it ends up in the low volatility portfolio. It's because the supply side deteriorated day over day. Now, I don't love that. Why? Well, because look at the correlation. So here price is falling, but supply dips. Well, there's probability then, because of this deficiency, that in coming days the price rises a little bit. And sure enough, it did. Now we have very steady demand, and price has been or supply has been a little above the trend. What is the probability? Well, that those reverse. I'm not, I don't. It wouldn't be my first choice. Would it be fine? Probably, but I don't love that as much as I would love, let's say, I mean, what's a good example? Let's look at another one in the low volatility portfolio. But that I literally will go through and look at them. Days like today. Every single component in that portfolio, I checked them all. They were all up to begin. And now several of them have pulled back this much. If you look at Microsoft, what I was talking about, the volatility, see it over here, close to 1. It wasn't quite all of that, but it was more than half of that. It was down call it 1.1%. And I'd look at that and say, wow, that's pretty appealing. But that's the fact that the last few days, the supply was above the 30-day trend. I don't love it as much as I might like. Let's look at another one. Maybe like is this Philip Morris? I think so. I mean, cigarettes are always a good low volatility choice. And, that to me is better. This higher level of supply caused price to deteriorate. Now that higher level of supply is gone, and it dropped day over day, and it stays right at 5 demand. Well, that's pretty appealing. If it dropped, all other things being equal, 1%, there's a very high probability of producing a 1% return. There it is. That's all of the data put together. And it's the difference between longer and shorter term trading. Long term, you could keep your stuff at 5 with good supply demand separation. Shorter term, you can look at stuff at 5 with deteriorating supply. When it comes back, we will know. Don't go chase a bunch of tech stocks when there's no momentum in the market. It will catch you out. Like today, probably a bunch of people bought Nvidia at $500 a share. Well, when there are no components in the momentum portfolio, don't fall for that. You will not miss out on something. It's really easy to think, well, I'm not in the market and the market's soaring. No, the data are much more reliable than what is happening minute by minute on a screen. And I would, it's very important to know. If there are 30 components of momentum, we can go chase momentum and make 25 or 30% in a 10-day period trading momentum. If there aren't any, then just be disciplined and recognize, okay, we'll have to still, until the data tell us otherwise, be happy taking 1 or 2%. Okay, I've got just really one more thing. Let me answer some questions if you got them. Bear with me a second here. Okay, am I missing anything? And any comments? If you want to share experiences, please do. If you've had good ones or bad ones that you'd like to share, I'm always happy to as well. SQL, right? That filter example, oh sure, I'd be happy to. And let me, I navigated away from it, but I absolutely can do that. I can put it in an image and share it. And it's just an example, Pam. Here, I'll give you another one because I was looking at this. If you want things that are very stable, if you want a sample of the, I'm just using it as an illustration, not a precise statement, but that if you wanted things that spend a lot of time at 5, you could say, well, let's have stocks that spend at least 15. That just means that half the time they tend to be 5s. And again, I like stocks that are, are liquid or large caps. but this is a good way to do it. If you go greater than or equal to $3,000, that puts you in the Russell 1000, really. It means we're going to find those kind of stocks. We want a supply-demand divergence, meaning that probably it's supply. If you're at 5, then supply is probably falling. I would say you want at least 1. You don't want this, it's not a momentum trade. This is different than that. So you want 1 standard deviation here. And let's say we want to screen out stuff that is maybe too heavily shorted. So we say we want short volume that is less than 50%. And these are not perfect, but it's just a way to think about this. And so I don't know what we're going to get. So we filter this, and we get 128 stocks. So what we could do is say, now we also want to get just the 5s. We just want stocks that are sitting at 5. So we come over here and we say demand is equal to 5. And that should narrow it down. And out of that, you could use some other criteria to narrow it further. In fact, we'll do one. So I want to look at what we get. And we get 75, but a lot of these are under 1% volatility. They're probably deal stocks. So let's take that out. You could come down here and say, I want some volatility, but not very much. We want it to be greater than or equal to, I'm going to take 1.1 because that's exactly half of the broad markets, the S&P 500's volatility, which is pretty close to, call it, 2.1 or 2. So that if you're half that, oftentimes that's deal arbitrage, keeping stocks in a range. So I'm going to eliminate those and then filter it. And out of this, you could build and you just keep stuff there. You could build a really nice portfolio and just look at the stocks that you end up with. Apple, AbbVie, Accenture, American Electric Power, AstraZeneca, BioMarin. I mean, you get a lot of really high quality stuff that probably gets overweighted in value or quality kinds of asset allocation portfolios. And you could sort it, you could like take off the smallest stuff if you wanted to. If it's down here in the 6-7 billion, like here 2 billion, these two are outside the Russell 1000. The floor is pretty close to 4 billion. So I might take those out. But out of that group, you could just keep a portfolio, you pick 10 of them and keep it weighted at these criteria. If they deteriorate out of it, you remove it and you find another. And you could set that up as a dynamic portfolio. I'm doing this for folks who don't want to be, I use this for short-term trading. I do. Longer-term stuff I have managed. But I mean, it's a great tool to do what people pay a lot of money to try to do, which is to find the stuff that will outperform. And here the math will do that most of the time for you. Okay, I've got just one thing left. Let me come back. Comments, thoughts, observations. Okay. Is there? Yes, there certainly. One of the videos, Pam, is it's not very long, but it takes you through those basic principles. So if you go over here and you click on Using Edge and you go to how it works, and I'm probably taking you back to something you've already seen, but it's a good reminder. Back in here, if you go to how to use Edge, one of these goes through the basics, and there are some others. Each of these will, like using your dashboard, that goes through some of those characteristics. Let me back up one because I think there's another one in here. In fact, it's right here. There are a bunch of these. Search for individual stocks, see what all the money's doing, create static portfolios, build, there you go. There's the one. Build dynamic portfolios. It's like that video is probably 2 years old or a year and a half old, but it goes through these basics for you. And so it's a good refresher. And it only runs about a minute, so they're really easy and short. Okay. And you say, well, Tim, you didn't tell me what to trade. No, I am. I am. Like if I look at this, I'd say we're at 4. We haven't, this, below 4 is a market bottom. You could go look at that, and we could back it up a year. How often has the market been right at this level? Well, here, when demand dropped below that green line, it was a clear, if you did the first one, you got caught. So that's a risk, but it's still, Getting to that level, that is a bottom. Happened back here. It's only happened 3 times over the past year. Below the green line, we had nice gains. Below the green line, had nice gains. How would you know to leave? Well, when broad sentiment deteriorates, yeah, you'd have to be, if it's short term, you'd be leaving twice. But if you used a longer read, you would say, when does it drop below 5? Just like your portfolio. That's probably for longer term portfolios. Now you know there is insufficient buy sell balance to keep the market supported. And we're very close to that level now. We're not all the way there. Could be there. I mean, maybe this is it. Maybe it will be a short term bottom. I don't love the market right now because there are no components in momentum, and even low volatility has come down. And at this moment, demand is still falling and supply is leveling off. It's not perfect data. I prefer to buy rising demand. You might miss out a little bit, but you have a better statistical probability of producing long gains when you do that than buying it when it's still falling. I'm all in cash at the moment in my short-term trading account for those reasons. Okay. Last thing is, and I've basically covered it there. I was going to say, well, what happens now? Well, if we say there's broad sentiment, context, and divergences, broad sentiment very close to a bottom. Context, there are no options expiring right now. There will be month-end expirations. We're not in an earnings reporting period particularly. I mean, people are reporting results all the time. Divergences, though, if you look at your dashboard, just scroll through. I do it very quickly in about 30 seconds in the morning. I've just kind of do this and just swing through. I mean, look at consumer discretionary. Terrible. Consumer staples, don't like that. Crypto stocks, horrible. Communications services, I don't like it. Everything I look at, financials, don't like it. Falling demand, rising supply, I mean, it's not terrible, but it's not good, right? Can you find anything in here that looks good? I can't. I mean, you could say, what about semiconductors? I mentioned this in the market desk note. Well, there is a recovery occurring in semiconductors. See that? And so there is a divergence forming in semiconductors, but demand is way below 5. So I look at the data and say it could recover in a matter of days, but nothing in that data makes me really exuberant about plowing money into the market because there is no good supply-demand divergence developing any place yet. Doesn't mean it won't, but all of this leads me back to I will look at low volatility trades. If there's an opportunity in these, I feel like we're getting close enough where that could be good. Then I will. That's where I'm going. It's the highest probability opportunity, and that's where I would go. Okay. Anything else? You guys want to weigh in? John, you got comments? Dan, anybody? Smarter than me?
I have a couple questions for you today.
Yeah.
So, like, what do you see? So, as we're hitting 4 here with broad sentiment, like, what do you see, like, kind of the lag within that signal? Is it a couple days, like, once things turn? I was just, kind of trying to figure out, like, to me, it's like almost a really good indicator of the medium-term trend in the market. And then my other question was, do you see it? Because my momentum portfolio is not picking up any short stocks either. Like, if you run a momentum that looks for short stocks, it's an interesting market from a momentum perspective. I don't know if yours is picking stuff up.
No, it's not. Yeah, and Brian noted that too. It is not a market that you can either safely go long or short in the data. I agree with you. Trend-wise, I think in 5 days is a very good repeating over and over high correlation indication. Like it's like there's if wherever you are, top or bottom, there's a 5-day correlation to when a turn occurs. It can be 1 day, it could be 10, but it keeps coming back to that central tendency. But that doesn't mean that the whole market will do that. But that to me that's what we look at in the data. We've seen it over and over and over and over for years and years. Yeah. So could mean, next week could be a good week. I don't know. I don't know, nor do I try to predict what's going to happen. I just look at the math every day and that I just use that. Let's see. Yeah, shorting. No, I'm not seeing it either. Yeah, right. Look, it's yeah. There's cash is pretty good under these conditions. I mean, I thought about, we're getting very close to you could do Brian likes to do this, you could do a levered long, levered short if you don't like if you're risk averse and you don't want to trade individual securities. I think the math is very good though for that. I think you can really avoid risk in individual securities if you use good stops and limits. Thank you for those lessons, you guys that pointed it out and advised it. But I admit I was looking at two times levered SPY instruments today. I think we're close to it, right? We're within 5 days. Yeah.
Yeah. I mean, it was a pretty 44% of the stocks in SPY, bottomed, right? So we were there again. It went to about 30, and now it's back there. So it'll be interesting to see what happens the next couple of days. And the percentage of stocks above 5 is only about 46%. So you need to see that demand come back, though.
Right. I agree. I feel like if the market has not demonstrated that it's a bottom yet. Another interesting thing you can use, there's no predictive quality to SPY, but it's the only ETF that is on the platform, and you can't go look for it in a portfolio because it's not in one. And the reason it's not predictive is ETFs they're derivatives, not in the conventional sense, not like a call option or put option, but they are a substitute instrument that depends on the underlying for prices. And what keeps SPY aligned with the underlying S&P 500 is arbitrage. And so it will not predict where the market is going to go. But look at this. I find this very interesting, that demand in SPY tends to cling to 5 because that's what it is. That arbitrageurs are going to say, well, if the basket is trading below SPY, you short SPY to get it in alignment with the underlying basket, and vice versa. So look what's happening in it. So demand's right at 5, but look at the supply side. We've gone from 49.5% right at options expirations to 57% now. Well, it suggests that the arbitrageurs aren't going to lift SPY back to what it was up here. Now, it can change. It's going to change every 3 days, basically, T+2. The basket will move back and forth. But I look at that and go, well, that doesn't give me the warm fuzzies. If I look at broad sentiment, I say, well, that doesn't give me the warm fuzzies. So, and I think that shows up in the fact that you can't find short trades and you can't find a lot of long trades. Okay, what do you do then? Well, if you don't want to take risk, sit in cash. All right, good enough. Good enough for this week. I will look forward to doing it next week, and I hope that we're out of the hospital and back home. Thank you. Yeah, thanks a lot, you guys. Brian, again, thanks for covering. John, good to see you. Good to see everybody.
See everyone.
Have a good rest of the week. Thank you very much.